The widow's penalty, why tax planning matters. I'm telling you, it's a big deal. So yesterday I sent an email to my email list, and if you're not subscribed, how dare you? Now, don't subscribe if you don't like my conspiracy theories or my politics or anything. Don't need you, and you don't want to get mad. Look, life's too short to let somebody make you mad. In fact, you should unsubscribe from my channel, as a matter of fact, because why go through that? People make you mad, just leave. It's no big deal. But anyway, so I sent an email talking about should you even do Roth conversions, and I'll do another video on that here as a follow-up to this video I'm about to do right now. The issue that comes, though, is that tax planning is a much bigger deal than investment planning. This is what drives me crazy. Financial advisors, so all they do is manage money. They say, what was that? Some guy was saying, I was just talking to some guy the other day. He's like, yeah, I talked to my guy. I forgot who it was, a Vanguard or someplace. I can't remember. And they're like, let me make sure I got it. All right, good. He's like, yeah, we don't do tax planning. We don't do investment. We don't do tax planning, estate planning. Basically not bubblegum freaking chewing planning. We don't do anything other than manage investments. And that's okay if you're going to call yourself an investment manager. But if you call yourself a financial advisor, a wealth manager, financial planner, how do you not do tax planning? Doesn't mean you have to actually do tax preparation, but it's crazy to me, man. I don't understand. How do you call yourself these things? It's nuts. And then the industry is like trying to ban people from using the term as financial planner unless they have like a freaking degree of some sort and they went through all this. Like, this is insanity, man. Anyway, tax planning is a big deal because guess what? Taxes could be one of your biggest expenses. Just a fact, man. Now, I talked about a video I did the other day on this. Some lady was saying taxes are going to be one of her biggest expenses and whatnot. I said, yeah, for some people it is. For other people, it's not. It really depends on your situation. But if taxes are going to be a big deal for you, and I really, we know this going in because you have so much in your IRAs, we need to do some planning. That's just a fact. So let's check this out. My man Amar. So we're going to go. Amar Shah had written this article. He said I could put it on my website. I'm going to link to his website as well. So we go to heritagewealthplanning.com, heritagewealthplanning.com. You'll see Ecclesiastes. I know there's nothing better for men than to rejoice and do good while they live. All right, that's from King Solomon. I know there's nothing better for men than to rejoice and do good while they live. All right, but faith not works. Faith not works. Oh, you need to have faith and you need to have works. Don't forget. Satan knew that Jesus was the Son of God. I mean, Satan knew that, just a fact. So he had faith that Jesus was the Son of God. So just attesting that Jesus is the Son of God, I'm not God. You got to have more than just faith. All right, so now we're going to scroll down here. And you can see I got this on commodities and everything that's up. Natural gas. You can see that. Pretty cool. I like that, actually. I like that chart. Pretty neat. And anyway, so now we're going to scroll down here. And we're going to scroll down to my most recent blog right here, The Widow's Tax Penalty, Why Tax Planning Matters. A guest post of Amar Shah. All right, and I'll put a link in the show notes for this article specifically. And, if you want to, look at that. Tax planning is our specialty. There you go. Who are these people? Let's take a look. AWLPMM. Oh, that's cool. So these are ads on my website. I don't know who they are. They do it through Google, I think. I'm not sure, but. Yeah, CPA firm. There you go. 404 in Atlanta too. Right on. Tax preparation, bookkeeping services. Cool. Yeah, well, good job, guys. I appreciate them advertising on my website. I mean, they're not on my website specifically, but I appreciate them. The Decatur. All right, cool. It's just not a. I don't like that website. They got their consultation right here on the front end. I don't like that at all. And they don't say a thing of who we are that I can see. They just got that. That's not a good website. They need to change that website. We got to know who you are, man. New client, schedule free consultation. They got to update that. They got to do better. All right, do better, people. Do better. All right, so we're gonna go down here. Yeah. But I appreciate them advertising on my website for sure. If you are interested in those, and look, here you got Ken Fisher, 9 reasons to avoid annuities. All right, so let's keep going. We see my man Amar Shah, clientfirstcap.com, sign up for Amar's email list. So we're going to go over here to Amar's email list, subscribe right there. The Widow's Penalty, Fourth Quarter Investment Planning Outlook, Mastering High Net Worth Financial Planning, Maximize Tax Benefits. Yeah, so look, he's doing all kinds of stuff. Estate planning in San Diego, all right. Ask a retiree. That sounds like a pretty, oh boy. Ask a retiree adapting retirement planning in the face of climate change. Oh, Amar. Oh, you're not falling for it, are you? Planning for retirement while many are choosing not to downsize. So Amar's, you just signed up for his thing, man. It's great. It's got good stuff on here. I like Amar. I don't care about climate change because it's all silly. The climate changes 4 times a year. Shocking. And it's not due to CO2. Oh my goodness, how dare you? All right, so he says, as if adjusting for the loss of your spouse isn't difficult enough, being the surviving widow or widower is often left facing an unexpected financial burden. Due to various tax laws, the surviving spouse usually experiences not only reduction in income, but oftentimes both higher taxes and higher Medicare costs. Yes, indeed, that's 100%, Amar. This double whammy can substantially reduce the amount of income the survivor has to meet their needs, which can actually increase after the loss of a partner. However, there are ways to mitigate that. So, first of all, you got to understand the problem. Yep, 100%. Typically, after the loss of a spouse, your income goes down. I don't think anyone would debate that. We know for a fact one of your Social Security is going to be reduced just right out of the gate. Yep. To make matters worse, the surviving spouse may actually have increased costs, especially for things they may have relied for the deceased spouse for. 100%, man. Physical care, household support, moving stuff from up there down here. That's what I have to do. The attic to the garage. We donated some stuff, and I had to drive, to Roswell to donate it so I could set up in this kid's house. Wife, what's she doing? She's sitting around smoking cigarettes and drinking beers, watching me do all the manual labor. Someone's got to freaking dig the holes in there so I can plant Charlotte's plants, right? Yeah, knucklehead. But it's true. I mean, how about mowing your yard? There may be need for physical care. All right, so filing status. Marginal tax rate. After the first year following death, the survivor now moves from the most favorable tax status of married filing jointly to the least favorable signal tax status. This means not only is income likely to be reduced, by a higher percentage of it now goes out to the taxes. For instance, in 2023, a married couple earning about $90,000 in taxable income. That's sans, that's without as we speak in French. That's sans, so basically go from your AGI. All right, so AGI to taxable income, that's your standard deductions. All right, so your AGI is about 120. AGI is adjusted gross income, and your taxable income is about 90. All right, obviously, it depends on your age, but still, you see, that's taxable income. I tell you, know the difference between taxable income and AGI. So a married couple earning basically $90,000 in taxable income pays a marginal tax rate of only 12%. A single taxpayer earning $45,000 per year is in the 22% marginal tax bracket. Yep. So in this scenario, the single spouse loses 10% more of their already reduced income to taxes. Yep. And then we got the fact that standard deductions going high or lower come the end of the Trump tax bill, 100% in 2026. Medicare, the IRMA. The Medicare IRMA, the Medicare Income-Related Monthly Adjustment Amount, is often called IRMA, as it's called, is a surcharge that's added to the monthly Medicare Part D and Part B premiums. It's based on the annual income and filing status of 2 years prior. Although this surcharge usually only applies to higher income families, the survivor may be surprised to find that due to their new tax filing status, their new premiums may actually be higher than when they were when they're together, just because they have more interest or more income, as they're subject to higher tax rates. Crazy. Net investment income. A consideration for higher net worth couples is a threshold for NII. Oftentimes, the surviving spouse retains the income from joint investment assets. In this case, a married filing jointly couple does not owe the 3.8% NII, net investment income tax, until the investment income exceeds $250,000. However, for a surviving spouse, it's just $200,000 threshold. Now, that's a lot of money. No one's going to cry over spilled milk there, but still, that's an issue. If you have $200,000 of net investment income, capital gains, qualified dividends, I think qualified dividends. I'm most positive qualified dividends. Capital gains, qualified dividends. I'm not sure if it's interest income. I can't remember. You have to look it up. But anyway, $200,000, a lot of times the capital gains dividends. It might well be interest income too. I just don't know. I don't feel like looking it up right now. You have to look at it. By the way, if you get $200,000 of that, you're going to pay an extra 3.8% in NII. You can look at my book, The Tax Bomb in Your Retirement Accounts. I don't have it here. I do talk about that. You don't know? You're a financial advisor? You don't know? Dude, I wrote a book on this. Trust me, I know. I just don't feel like looking up. I can't remember everything. There's this thing called the internet. You can look this stuff very easily. But why don't you? Is it your money that you're worried about? Take some ownership, guy. Take some ownership. But I don't want to. I want Bojida to do it all for me. The best approach is to minimize the widow's penalty is to increase tax-free income in retirement. The biggest opportunity lies with large IRA accounts. Yeah, 100%. Because RMDs from traditional IRAs usually consist of entirely taxable income to the surviving spouse, thus increasing their taxable income in marginal tax bracket, which affects their NII, the amount they have to pay for NII, potentially because it puts them in a higher tax bracket. They might have other income they have to pay, the NII, other income for net investment income, the IRMA when it comes to Medicare premiums, and obviously just your higher taxes that you got to pay as well. It's just, there's not much, I mean, it's just, I don't think anyone would debate this. RMDs from traditional IRAs usually consist of, yeah, we're going to talk about that, right? Let's keep going here. Minimize large IRAs while the spouse is alive. Dude, it looks like she's not too keen on this guy kissing her. She's like, me too, pound me too. Dude, did you get permission there, guy? That's a weird picture. And she's like, who is this creep? The best option is to reduce these taxable IRA accounts while both spouses are alive, 100%. You can do, and this is what I talk about in my email, by doing Roth conversions or just taking distributions out before Social Security. So I'll do another video on that later today about should you even bother with Roth conversions or how to mitigate the widow's tax trap. And literally what we're trying to do is we're trying to defer Social Security as long as we can. Not all the time. Everyone's different. I always get, well, Josh, you told me. Look, every single person is different who I work with. It's just a fact. But generally speaking, we want to defer Social Security, because remember, Social Security is one of the best tax-free investments you can have, 100%. It's not tax-free. It is if the vast majority of your income, Social Security is tax-free, guy. It is 100%. I'll prove it to you next video, so stay tuned. But anyway, so we want to take distributions out of our IRA while we're deferring Social Security. What does that do? Well, that reduces the amount of the IRA, obviously, and it reduces the growth of the IRA as well because we've now taken distributions. And it allows us to keep Social Security at that 8% delayed earning credit clip. And because Social Security is so advantageous from a tax perspective, the more Social Security, the less tax we pay. It's just a fact. $100,000 of Social Security, even if you're freaking Bill Gates, the first $15,000 of that is tax-free. That is just a fact. $50,000 of Social Security, the first $15,000 is tax-free. But $100,000 of Social Security, that's $15,000 of tax-free income. $50,000 is only $7,500. So from a percentage, it's the same, but for the actual dollar amount, it's not even close to the same. You see? The more Social Security we get, the less taxes we pay. It's just a fact, dude. So we want to defer Social Security. Now, we can take Roth conversions too, don't get me wrong, but generally speaking, I don't say we should. We want to pull money from our IRA while we're deferring Social Security. Now, if you're already on Social Security, that's a moot point. You got to look at, is it worth doing Roth conversions or not? And a lot of times it's just not at that stage. No, not all the time. Every situation is unique. But here, I'm 53. All my money is now in Roth, all of it. I have no more pre-tax money. Charlotte's 49, I'm 53. So in 10 years, I'll be 63, eligible for Social Security. I absolutely do not plan on taking that money out. I got a thing in my throat. I feel like I want to sneeze or hold on, I sneeze, I think. Hold on a sec. All right, so what's going to happen when I'm 63? Let's just say my Roth is worth $500,000. Just use that for an example. All right, and I'll take 5%. Probably let's just say, well, I'll sell my house. I'll live off the proceeds of my house. Maybe live off the proceeds of my Roth. And I'll just let Social Security keep deferring and deferring and deferring. So so I have house proceeds essentially tax-free. Roth proceeds definitively tax-free. And the reason I say essentially tax-free because hopefully I'm still getting 5% interest on the house proceeds. So let's just say I net $500,000 on my home. I got $500,000 in Roth, $500,000 in my home and Social Security. All right, so that's $1 million. All that's tax-free. I mean, again, we'll get some interest income on that $500,000. So let's say it's 5% a year. That's $25,000 a year. I spend that down. That'll be taxed as ordinary income for sure. Still, with my Charlotte and me, that our standard deduction and personal exemptions at that point are well beyond that anyway. So no big deal. We can pay no tax. Roth kicks in, no tax. Social Security kicks in, no tax. That's the way to do it. But you paid all this tax. Yeah, 100%. I'm getting hammered the last couple of years without question. What I just say all the time is, man, Pay the freaking Caesar what's Caesar. That way, because you don't know what the future holds, but you do know there's going to be tax consequences. And I'm just telling you, I don't want to rant too much here. It's a whole different ballgame when you stop working, and now a big tax component, a big tax bill is problematic. Even though you're like, yeah, but it's a lower tax bill than it was when I was working. I'm telling you, man, it's a different ballgame. It's nerve-wracking if you're down to your last couple $100,000 in Social Security. Yes, you're not have to pay a huge amount of tax, but any amount of tax is a big deal. It's a big deal. If you can pay it while the money's good, because it's like the buy term and invest the rest. I'll defer now and I'll invest. Who does? I mean, you can, but do you actually do that to the extent of your deferrals? I don't think so. I mean, how much tax deferrals you're getting. I just don't think a lot of people do. They consume that money. It's kind of like buy term and invest the rest. Who actually invest all the rest? They might invest some of the rest, but do we invest it all? Man, you pay the tax man while the getting's good. That way you don't have to worry about it later on when the getting could be bad. All right. Love your thoughts. Don't forget to subscribe to the email list down below. And check out Amar's website as well. Sign up for his. And I'll put a link in the show notes. And I love your thoughts. See you.